everyone, and in this video we are going to continue with payroll accounting and we are going to cover chapter 6. Chapter 6 is going to cover payroll register, earnings, records, and accounting system entries. So the first learning objective in chapter 6 is creating the payroll register. Now, the nice thing about the payroll register that accountants must keep in mind is that it contains all the payroll data for the pay period, including wages, gross wages, deductions, and net pay. And this is covered on page 206 in your book. Also contained in the payroll register is the marital status, withholdings, regular pay, overtime pay, any deductions that the employee may have off their payroll check, along with the net pay that will be deposited into their account. Now, total, prove, and rule the register. Total, each column is very, very important when you do the payroll register, and the rows are totaled. Prove, the column totals are added horizontally and rows are totaled vertically. And the aggregate column and rows must be equal. So that's kind of a check figure to make sure that the payroll register is calculating correctly. The rule for doing the payroll register is that column totals are doubled, underlined to show that the totals have been proven out. This is an example of the payroll register that will be covered in this chapter. Okay, we'll make it a little bit bigger. There is a template in the learning plan folder if you'd like to utilize the template when you are working through the homework for chapter 6. Now, learning objective number 2, this is where we transfer the payroll data to the employee's earning records. And this is covered on page 207 and 208 in your book. What this is that it's the companion piece to the payroll register. So what that means is that everything off the payroll register is going to go to the employee's earning record for one employee, which the employee will see the year-to-date earnings for tax limits, voluntary deductions, any changes in marital status, or the number of withholding allowances. This is used to facilitate those W-2s at the end of the year for tax purposes. This is an example of an employee earnings record, which is on page 208 in your book. As you notice here, it gives us the total hours, wages, all the withholdings, and the net pay for each employee for each month. Learning objective number 3. This is the financial accounting concepts covered for payroll. Remember, in accounting, the basic rule is assets equals liabilities plus owner's equity, which spells ALO. You can remember the word ALO, you will remember the accounting formula. So as you know, assets is cash or other items that are used in the operation of the business and amounts owed to the company by customers. An example would be accounts receivable. Other items that they might own would be inventory, possibly equipment, machinery, and even cash. Assets equals liabilities. Liabilities are the amounts owed by the business to other people or companies. So basically it's their accounts payable or any type of loans that they have taken out for the business. Owner's equity, that's the net investment that owner has in the business. Businesses include earnings kept in the business. So very, very important to understand the accounting formula of assets equals liabilities plus stockholders' equity. Now, some examples of financial accounting concepts. Accountants would classify transactions into 2 accounts, assets and owner's equity. So in order to increase the asset, we will debit that asset. And then as you notice on the other side of the equation, that it has to be a credit in order for that accounting equation to balance. Remember, the accounting equation must balance. Okay, so instead of using T accounts, accountants use debits and credits. Debits are abbreviated by DR, which means the left side of the T account, and credits are abbreviated by CR, which is the right side of the T account. So in order to increase with a debit, the accounts that increase with a debit are expenses, assets, and the drawing account. The accounts that increase with credits are liabilities, equity, and revenue. As you notice, the debits are on one side of the equation and the credits are on the other side of the equation. Now, this is covered on page 209 in your book. Now, the learning concept number 4, which is on page 211, is completing the financial transactions and putting them into a general ledger. Okay, so when an accountant puts it into a general ledger, the first thing they want to do is put down the date. And then what you're going to do is that you're going to record those entries into the general ledger by account. So as you notice here, the date is August 1st. We are going to debit cash. Usually your debits are always on top with the post reference. That's your reference. That's from the journals. Debit for $4,000, and then you're going to credit the capital account for $4,000. Now, as you know, any type of accounting transactions, including payroll, have to be related to general journal entries. So as you notice in this example in your book, which is on page 211, NC Bikes has completed the payroll register and is ready to issue checks. So in order to record that journal entry on the book for the employee share, the accountant would make the journal entry based on the date of the payroll. As you notice, we're going to debit salaries and wages expense for $18,050. The expense account is always debited for the gross wages. Next, you're going to credit all the liability accounts, which is all the deductions taken off the employee payroll check. The reason why they're always liabilities is because these insurances and taxes will be paid within the month or the next month. So they don't have to pay them right now, but they need to put them on the books as a liability. And then as you notice, January 31st is a salary and wages payable. This is the net amount that is deposited into the employee's checking account for their payroll after all deductions. And then once the first entry is made on January 28th, the second entry made is on January 31st when it gets deposited into the employee's account. You will debit salaries and wage payable, and then you will credit cash to clear off that liability on the books because the employees have been paid. Now, this is covered on pages 211, 212, and even page 213. If you do have any questions, please let me know. Now, the first entry was the employee payroll transactions. The second journal entry that is made is the employer's payroll transactions. So as you recall from previous chapters, Social Security and Medicare tax, whatever the employee pays, the employer pays the exact same amount, along with some extra unemployment taxes. So in this example here, they give us the unemployment taxes. And in order to make the employer's payroll journal entries, we are going to debit payroll tax expense, and then you're going to credit all the payable accounts for liabilities for those taxes. So Social Security tax payable, Medicare tax payable, FUTA tax payable, which they give you the dollar amounts, and then SUTA tax payable. Now remember, this is the employer's share of the taxes that must be recorded in the general journal entries in order for it to flow into the financial statements. Some other payroll related entries, as you notice, when they make those entries to pay off those voluntary deductions like 401k or the insurance, remember, in order to reduce the liabilities, you're going to debit the payable account and then credit cash. Now, payrolls may be split in between 2 months. One thing that accountants must keep in mind is that it needs to reflect the accrued payroll due but not paid and match the expenses to the correct period. This is called the matching principle. Okay, so what we're going to do here, which is covered on page 212 in your book, is to create an adjusting entry. So what it is here is that the accountant would make the entry for March 31st payroll. As you notice, we're going to debit the wage expense account and then credit all the liabilities accounts associated with that payroll, along with the adjusting entry for the employer's share of those taxes in order to make sure our expenses match the revenue for the month. Okay, at the beginning of April then, that payroll entry would be reversed. So it's called a reversing entry. And the reason being is that these are entries after the start of the next period to prevent confusion in the payroll accounting process. So basically, you're recording the expense at the end of March in order to recognize it. When the beginning of the next month comes due, you reverse that because the payroll is actually going to be paid in the month of April, but we want to recognize the expenses in the month of March. All right, learning objective number 5 is just recording all the entries that we have made, is the list of transactions classified by each account, and to balance each account accordingly. As you notice, we're posting all the journal entries line by line by date in order to make sure that our general ledger does balance. Okay, and this is covered on page 214 and 215 in your book. Okay, so you're just going to basically record your debits and credits and get your ending balance. Now, one thing to keep in mind, the reason why these do have to be recorded, which is learning objective number 6, is that these items show up in the balance sheet, the income statement, and the trial balance. As you notice, the expenses get rolled into the income statement. Remember, it's your revenue minus your expenses equals your net income. So it's very important that all those payroll journal entries are recorded in the general journal. Next, then all the assets equals liabilities plus stockholders' equity. As you notice, all of our liability accounts are recorded on the balance sheet to make sure that we're in balance with all the transactions that took place throughout the month. This is very important because it just shows the financial stability of the company at month end. And then the trial balance is just making sure that all of our debits and credits were recorded properly in each of the accounts set up for the month. The labor report is just designed to inform managers and departments head to show where the labor was used within the company. Many managers will review this on a weekly basis or even every payroll basis to ensure that the labor expenses are allocated properly to each department. Okay, and this figure is covered on page 222 in your book. Okay, it is important for each account to review the entries recorded in the payroll to make sure they are recorded correctly to control the expenses. So if you do have any questions in regards to the PowerPoint presentation or Chapter 6, please let me know. Thank you.